This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're now going to go through and look at the accounting treatment of convertible instruments. And when we're looking at the accounting treatment of convertible instruments, the key bit that we're looking at is substance. We're going to look at the economic reality of what this financial instrument actually looks like. Because what happens with a convertible instrument is when it is issued by the company looking to raise finance, it receives the cash from the investor, and then the investor has the right to either take the cash back on redemption or convert for shares. Okay, so even though legally it is a debt instrument, there is this option to convert to shares at some point in the future. So when we're looking at the definitions of financial instruments, there is a liability element, isn't there? Because there is an obligation to pay cash. But there is also the option to take shares, which is giving the investor then a residual interest in the net assets of the entity. So when we look at the initial accounting, what we're going to have to do is we're going to use this process referred to as split equity accounting. And by that, what we mean is we record the cash proceeds with the debit to our bank, but then we are going to go through there and credit a liability and also credit some portion of equity. Okay. The issue that you have then got is we know the proceeds, but what are we going to record as the credit to the liability, and what are we going to record as the credit to the equity? Okay. And what we do is we work out the value of the liability first. So what we go through and do there is we discount the maximum possible amount of cash that will be repaid. So we just assume that everybody takes the cash option. Nobody converts for shares. It's just a way in which we do it. We assume that it is a simple loan. Okay. So we look at all the cash. So we look at the coupon rate of interest, and we look at the amount that it will be redeemed at in the future, which will be at par. Okay. When you're looking there at the discount rate, what you need to do there is you use the discount rate with your interest on similar debt. So similar debt with regard to the amount without the conversion option. So if you wanted to issue convertible debt to raise $1 million, then you would discount the cash flows based on the interest and the redemption of the $1 million, and you would use the interest rate that would be there on a normal, simple loan if you were to borrow the $1 million from the bank. Okay. The words used in the standard and in the exam is that is the interest rate on similar debt without the conversion option. Okay, so there's going to be a little bit of discounting involved. Nothing huge, nothing to catch you out, but you still need to be able to do the discounting. Once you've worked out the value of the liability, you can then work out the equity. And the equity is quite simply just the difference between the proceeds that you have on issue and the value of the liability. Okay, that's it. So you're going to debit the bank with the proceeds, credit the liability, and then that balancing credit figure that you have is just taken there to equity, usually going through your other components of equity. So that's how you look at it initially. The next paragraph, it talks about things subsequently. So subsequently you have a liability. Liabilities are then measured at amortized cost, aren't they? And then when you look at the equity, that is not subsequently changed. You will change it when we get to conversion, but we're not worried about that there. Once you've recognized the equity element, you leave it. That's it. Okay, you do not change it every single year. Okay, so that's it. That's what we need to go through and look at. Let's have a look at the example that you've got just underneath. Is it referred to as Peter? Okay, and what it wants us to go through and do is it wants us to prepare extracts from your statement of profit or loss, your position, at the end of the first year of issue. So it's not looking at just the initial recognition, but also the subsequent recognition. Okay. So what have we got? It says Peter issues $100,000 of 4% convertible loan stock. So that's important. It's convertible. If it's convertible, we're in the world of split accounting, aren't we? And it's convertible, is it in 3 years' time? So when we're doing any discounting to work out the liability element, we're going to have to discount for 3 years. The market rate of interest on similar debt without the conversion option. So the discount rate essentially, or the market rate of interest, is there at 8%. So the cash flows you need to discount back. Okay. Those cash flows that we're going to go through and discount back are going to be the redemption value, which is par value at 100,000, and the annual interest is 4%, isn't it, on that 100,000. Okay. So let's not worry about the extracts just for now. Let's just think about the discounting. So what we've got there, we're going to look at our year. So year 1, 2, 3. The cash flows for 3 years, you have 4,000, don't we? If you're curious as to where that's from, maybe you've worked it out already, but that's the 4% coupon rate multiplied by the par value, isn't it? Okay. Our discount factors are going to be there based upon, is it 8%? And the figures that you've got, hopefully, from the question are 0.926, 0.857, and 0.793. Okay. If ever you're stuck within the exam, just use the discount factors for the higher rate. That goes through there and gives you your present value when you multiply across. So is that 3704? Is it 3428? You need to be careful with the cash flows, however, in that third year, it's not only just the coupon interest, it's also the amount of the loan as well. So the 100,000 redemption plus the 4,000. Okay, so keep an eye out on that there. If you tap that in, is that 82472? Which, when you total that up, does that give me 89604? We know that the proceeds are equal to 100,000. We've worked out the liability element, haven't we? So the balancing figure, the difference between the two, is that at 10,396. That is the equity amount. Okay, if you want your debits and credits, you would debit the bank with the proceeds, you would credit the liability, and then you will credit the equity. Okay, that would be there. Would that be initially? Okay, excellent. Question wanted us to go through as well, didn't it? And look at the figures at the end of the year. Okay, so what you've got there, if we throw in a new page, if I'm looking at my statement of financial position and my statement of profit or loss, on the SFP, you have your equity, don't you? And the equity figure that we calculated was 10,396. We don't need to make any adjustment to that whatsoever. We also then have your debt element. So you have your 4%, is it convertible debt? What we'll need to do there is we will need to do a working help us work out not just the year-end liability, but also the finance costs. Okay, so what you've got there is that if we draw in a separate working, so are we looking there, is it at year 1? My brought forward figure was that 89604. The interest, well, if we discounted it back at 8%, we will use 8% to unwind it, won't we? So 89604 times by 8%. Does that give me 7168? And don't forget as well that the amount of cash that you will have paid is the 4,000, isn't it? The 4% on the coupon rate. Does that give me a carry forward figure of 92772? Okay, so my liability is at 92772 at the end of the first year. So you can see that that liability is growing closer and closer to our redemption value, which was 100,000. I think if you were to carry it on for the next 3 years, you should get close to 100,000. And then your finance costs are there at 7168. Okay, there we go. Again, don't worry too much about the debits and credits. Make sure that you understand how this instrument works. You split it initially into a debt element and an equity element. And the debt element is the present value of the cash flows discounted at the market rate of interest. Once you've worked out the value of the liability, the equity is the difference between the proceeds and the liability. And then the subsequent treatment is that here, the 4% convertibles, the debt is treated, isn't it, at your amortized cost. So you apply the effective rate of interest, that market rate of 8% to the outstanding liability, which increases the liability. You then reduce the liability by any amounts that you are contractually obliged to pay back, which is the coupon rate multiplied by the par value, and then that will give you your closing liability. The key bit about the equity, remember, is that remains unchanged until conversion happens, and we will worry about that at a later date. Okay, not to be seen here within your F2 exam. There's enough going on with financial instruments as it is. So what I'll do is I'll go through, work that example again, make sure you're happy with it. If you're happy with it, then go through and have a look at the example question. Okay, see you later.